What if I told you that the MACD indicator, one of the most trusted momentum tools in technical analysis, has critical flaws that have been costing traders money for over 40 years? And that there's a revolutionary solution that won the prestigious CMT Association Charles Dow Award in 2022. In this video, we're revealing the MACD V indicator, a breakthrough that transforms the classic MACD into a precision timing tool that works across any market and any time frame. Before we move forward, I want to clarify something. I rely on MACD extensively as part of the entry criteria and in managing exits. The limitations discussed in this video don't affect my process. I use many other variables in conjunction with MACD to form an entry decision. For exits, our focus is on detecting changes in momentum, and that's something MACD captures exceptionally well in its purest form. The refined indicator, MACD-V, took 8 years to develop and earned recognition from two of the most prestigious technical analysis organizations in the world. Alex Baroglu's groundbreaking work won both the CMT Association's Charles Dow Award and the National Association of Active Investment Managers Founders Award in 2022. Achievements that fewer than 20 people globally have accomplished. By the end of this video, you'll understand exactly why your MACD signals have been inconsistent, why the same MACD reading means completely different things in different markets, and most importantly, how the MACD-V creates what's called the Momentum Lifecycle roadmap that delivers consistent, actionable signals across all securities and timeframes. Gerald Appel's MACD indicator revolutionized momentum analysis when it debuted in the late 1970s. The formula is elegantly simple. Take a 12-period EMA, subtract a 26-period EMA, add a 9-period signal line, and you have a trend-following momentum indicator that captures market acceleration and deceleration. But the MACD has 5 critical limitations that make it unreliable for consistent trading results for traders who depend solely on the indicator for their trading signals. Let me show you exactly what these are and why they matter. Limitation number 1. The MACD isn't comparable across time. This is the most shocking discovery. MACD readings from different time periods are mathematically meaningless to compare, even for the same security. Here are the actual numbers from the S&P 500. Between 1957 and 1971, the MACD maximum was 1.56 and the minimum was minus 3.3. Between 2019 and 2021, the MACD maximum was 86.31 and the minimum was minus 225.4. Does this mean that the market had 55 times more momentum in 2021 than in 1971? Absolutely not. The difference exists purely because the MACD is an absolute price indicator. It depends on the underlying security's price level when calculated. This creates a devastating problem. You cannot compare today's MACD reading with last year's reading, let alone readings from a decade ago. Any historical analysis becomes meaningless, and backtesting results are fundamentally flawed. Limitation 2. The MACD isn't comparable across markets. The second limitation stems directly from the first. If MACD readings aren't stable across time, they certainly can't be compared across different securities. Consider this real example. The S&P 500's MACD reading might be 65, while the Euro's MACD reading is minus 0.007. This doesn't mean the S&P 500 has more momentum. It's simply a function of the different absolute price levels of those securities. This makes cross-market analysis impossible. You cannot scan for the strongest momentum across a universe of stocks, compare forex pairs, or build relative strength strategies using MACD readings. Each security exists in its own isolated MACD universe. Limitation number 3. No objective momentum framework. Because MACD values aren't comparable across time or markets, you cannot create objective overbought or oversold levels. Unlike indicators that operate within fixed ranges, the MACD has no universal benchmarks. This means you cannot systematically define when momentum is high versus low, when markets are stretched, or when conditions favor mean reversion versus trend continuation. Every MACD analysis becomes subjective and unrepeatable. Limitation 4. Signal line accuracy problems. The MACD's signal line crossovers, the primary method for generating buy and sell signals, suffer from a critical accuracy problem in low momentum environments. When markets lack directional conviction, the MACD line hovers near zero and close to the signal line. This creates frequent crossovers that generate numerous false signals. In ranging markets, you might see 6 or more losing signals in just a few months. Because of limitation number 3, you cannot filter these signals by identifying low momentum environments objectively. You're forced to take every signal, including the inevitable whipsaws. And limitation number 5, signal line timing problems. Conversely, when momentum is extremely high, the MACD line builds significant distance from the signal line. If the market then reverses abruptly, common in V-shaped bottoms, the lagging signal line takes considerable time to catch up. This creates accurate but late signals. For example, the S&P 500 bottomed at $2,532.69 on February 9, 2018, but the MACD signal didn't trigger until February 23 at $2,747.30, a devastating 8.47% late to the party. Again, without objective momentum levels, you cannot anticipate these high momentum environments and adjust your strategy accordingly. It's not that these limitations were overlooked until now. Recognizing these very limitations, technical analysts created the percent price oscillator, or PPO. The logic seemed sound. Normalize the MACD by expressing it as a percentage of price. The PPO formula? 12 EMA minus 26 AMA divided by the 26 EMA times 100. This approach does solve limitation number 1. PPO readings become comparable across time for individual securities. For the S&P 500, 95% of PPO values consistently fall between +2 and -2% across decades. But the PPO fails spectacularly at solving the other limitations. Different markets require completely different PPO levels. For the S&P 500, values in excess of +or -2% are extreme readings. For the German Bund, values beyond +or -0.7% are extreme readings, and for natural gas, only values exceeding +or -7% would be classified as extreme. A 0.5% PPO reading indicates strong momentum in the Bund, but represents a nearly flat market in the S&P 500. The PPO normalizes by price, but ignores the fundamental driver of these differences: volatility. This is where Alex Spiroglu's 8 years of research culminated in a revolutionary insight. Instead of normalizing by price, normalize by volatility itself. The MACD-V formula is elegantly simple. Take the 12-period EMA, subtract the 26-period EMA, and divide by the 26-period ATR. Then times the whole thing by 100. By dividing the traditional MACD by the average true range, Wells Wilder's proven volatility measure, we create something unprecedented in technical analysis: a momentum indicator that solves all 5 MACD limitations simultaneously. How MACD-V solves limitation number 1, time stability. Because volatility normalization removes the absolute price component, MACD-V readings become directly comparable across time. A reading of 100 today has the same mathematical meaning as a reading of 100 from 1975. This enables genuine historical analysis and reliable backtesting. You can finally compare momentum conditions across decades with mathematical precision. How MACD-V solves limitation number 2, cross-market comparability. The breakthrough discovery? Using the same ± 150 extreme levels, works across all markets. For the S&P 500, 95% of all readings fall within minus to plus 150. For the German Bund, 95% of readings fall within the same range of minus to plus 150. And for natural gas, it's the same story. 95% of readings fall within the range from minus 150 to plus 150. For the first time in technical analysis history, we have universal momentum levels that work across stocks, bonds, commodities, currencies, and cryptocurrencies. How the MACD solves limitation number 3, Objective Momentum Framework. With universal levels established, we can create the 7-stage Momentum Lifecycle roadmap, with risk levels exceeding plus or minus 150. Momentum exceeds 1.5 times volatility. Markets are stretched. Strong momentum, 50 to 150 or minus 50 to minus 150, shows sustained directional movement. The neutral range between minus 50 and plus 50, low momentum ranging conditions, and specific states, rallying, retracing, rebounding, reversing, ranging. Each state has objective mathematical definitions that work universally across all markets and timeframes. How MACD solves limitations number 4 and 5, signal quality. With objective momentum levels, you can now filter signals based on market conditions. Avoid signals in the neutral range between minus 50 and plus 50, where whipsaws dominate. Anticipate timing issues in extreme momentum environments exceeding plus or minus 150. Focus on high probability signals in strong momentum ranges. Through extensive backtesting, Spiroglu discovered something remarkable about how MACD behaves in different trend environments. This creates what he calls range rules, objective guidelines that dramatically improve signal accuracy. Bullish regime is defined as the asset trading above the 200-day EMA. In the bullish regime for the S&P 500, 100% of extreme overbought readings, beyond 150, occur in bull markets. 0% of extreme oversold readings, less than minus 150, occur in bull markets. 99.4% of all readings stay above minus 100, therefore, within the bullish stage, the minus 50 to minus 150 range becomes a new oversold level, capturing 5% of the downside data. This also means that in bull markets, any MACD reading below minus 100 is extraordinarily rare and often marks significant buying opportunities. In the bearish regime below the 200-day moving average for the S&P 500, 100% of extreme oversold readings below minus 150 occur in bear markets. 0% of extreme overbought readings above 150 occur in bear markets. 99.8% of readings stay below plus 100. These range rules work across all markets and provide precise entry and exit guidelines that were impossible with the classic MACD. To demonstrate practical application, Spiroglu tested a simple momentum system on DAX futures from 1991 to 2021. System rules. Enter long when the MACD exceeds 70. Strong upward momentum. Exit at 2.85% profit target or after 15 days if profitable. The maximum hold period was set at 77 days. The results? 201 profitable trades over 30 years, 95 trades, 77.23%, reached their profit target, consistent performance across different market cycles, and clear risk management with defined exit rules. Alex says this system is not a tradable system on its own, but serves as inspiration for further strategy idea development. However, it demonstrates how MACD's normalized readings enable systematic quantified approaches that generate consistent results, something impossible with traditional MACD analysis. The innovation extends to the histogram as well. The MACD histogram, or MACD-VH, provides normalized short-term momentum readings with extreme levels at plus or minus 40. Unlike traditional histogram analysis that relies on subjective bar height comparisons, MACD VH gives you absolute levels that work across all markets for identifying short-term stretched conditions and brief reversal opportunities. The MACD V addresses the core problem that undermines most momentum-based strategies: inconsistent, non-comparable readings that make systematic analysis impossible. With MACD V, you gain consistent signal quality. Universal momentum levels eliminates the guesswork. You know exactly when momentum is strong, weak, or extreme across any market. Reliable backtesting. Time-stable readings enable genuine historical analysis and strategy development that actually works in live trading. Cross-market strategies. Compare momentum across different asset classes, build relative strength systems, and diversify using consistent momentum criteria. Objective risk management. Range rules provide precise guidelines for position sizing, stop placement, and profit-taking based on momentum conditions. Systematic approach. Transform subjective MACD analysis into quantified, repeatable strategies that can be programmed, backtested, and optimized. Most importantly, MACD V works the same way whether you're trading individual stocks, forex pairs, commodity futures, or cryptocurrency markets. The universal nature of volatility normalization means your momentum analysis skills transfer seamlessly across all asset classes. The MACD V isn't just an improvement, it's a complete paradigm shift that transforms momentum analysis from subjective art into objective science. By normalizing against volatility rather than price, we finally have universal momentum readings that work consistently across all markets and timeframes. The solution to MACD's limitations wasn't to abandon the indicator, but to fix its fundamental mathematical flaw, which MACD V does really well. Remember, momentum is primarily a timing tool. It helps you enter trends at optimal levels, avoid false signals in low momentum environments, and identify high-probability reversal zones. The MACD V makes all of this possible with mathematical precision. For those who want to try the indicator, it's available on Metastock and StockChart's advanced trading platform, and it will soon be available on other popular charting platforms including TradingView, MT4, and NinjaTrader. So, try it out and let me know what you think about it in the comments section. As always, thanks for watching.